We're going to get down and dirty now. We're going to have a moderated session where we're going to screen out some of these important facts, important to rigor investment process. So, Staten James, where are we? He's hiding somewhere in the corner here. Welcome to the podium. State Manager of AMP. Got to welcome on stage Andre Ventelon, who's a senior researcher from Morgan Stanley. So, where are we? He's up here somewhere. Here he is behind me. Come on, gentlemen. Don't be afraid.
Thanks, Mike. Cheers.
Let's take it away. We've got the couch session, sort of. Is this a couch or whatever? Seat?
Thank you.
Thank you. Thanks, Mike. Thanks for the warm introduction, and thanks to IMAP for having us along today. Really appreciate your time here this morning. My name's Staten James. I'm from the North Platform, and shortly I'll introduce Alex from Morgan Stanley. They've recently launched their managed accounts on the North Platform. We're pleased to be working together today to be able to present to you. A reminder of some really solid statistics. Andrew went through a lot of those, and thank you, Andrew. As at 31 December, funds under management in managed accounts stood at 132 billion there or thereabouts, which is an increase of 21 billion over the last 6 months. And so we're rapidly seeing the growth of managed accounts across the industry and approaching 40% per year. North, our product, we've seen significant increase. We've just hit $5 billion and 140% over the last 12 months or so. So no doubt managed accounts are definitely being supported. A lot of you in the room today, per your hands that were being raised. So thank you very much for that, obviously. But what about the importance of a rigorous investment process to deliver on client goals? So with that, I'll introduce Alex to talk about that in some more detail. So Alex is the Executive Director, Head of Research Wealth Management at Morgan Stanley. He's developed Morgan Stanley's multi-asset investment approach, which was recognised by IMAP as the winner in 2020 and 2021 licensee managed account category, plus the 2021 multi-asset class category. Alex has more than 15 years of investment management experience in both wealth and institutional money management, and prior to joining Morgan Stanley in 2017, Alex was the investment strategist at Australian Super and also worked as a multi-asset portfolio manager at Credit Suisse, both here and overseas, Europe and Asia. So everyone, please welcome Alex Ventelon.
Thank you. All right, good morning, everyone. Thanks for having me today. It's always good to be back in presence in the room. A lot of things are happening right now. We had a busy night, as you can see on my face, with markets and the Fed bringing in more action to the capital markets, obviously influencing the outcome for both bond and equity investors. It was a positive one this time around, but since the beginning of the year, things have been quite dramatic for investors across the board. So what we wanted to touch on today is give you a few leads as to how we going about investing at Morgan Stanley in our multi-asset investing process, how you can find ways to better manage risk and return through the cycles and deliver good outcomes to clients. But the first thing I wanted to touch on is really, why multi-assets now, right? There's two points I wanted to touch on in that regard, which are mostly linked to the fact that, inflation is going to be high, right? Inflation has, if one thing hasn't surprised that, is surprising us each and every time on the prints, right? It's come out every time above expectations, and it's likely will continue to do so. And we've had to reset expectations over and over again. What it means, and I also like to point to the fact that, back in November, the Fed was pointing to temporary inflation pressure, right? So the Fed had it wrong, the economists had it wrong, we had it wrong as a financial markets community. Now it's about how you respond to that, how you adapt to that, because we might be in that tricky environment for a while longer. But it's important in that environment, in our view, to stay invested. Okay, we'll talk about where to be invested right now, but staying invested on behalf of your clients, we think is really key, because inflation, as it's surprising to the upside, will erode the value of savings. Right? So even though the central banks are trying to catch up on inflation, the cash rates are going to stay behind inflation for a while longer. And what I drew on that chart is that in Australia, we've been blessed with quite high cash rates, making time deposit or even cash savings rate on a bank account quite interesting investments in the past 20 years. But in 4 of the last 5 years, in real terms, once you adjust for inflation, if you left your money on a savings account, you've lost money in real term, right? It's going to get worse this year. And remember that those forecasts were done, we just revised them overnight based on the minimum wage increase. We were thinking we would have an average inflation of 4.6% this year. We're going to have more than that. So this red bar of how much money is going to be lost in real term versus cash is going to go deeper down. Right, and next year as well, we are expecting real returns to be negative on cash. So how you fight that? You fight that by being investing in asset class that have a high carry, and you need to diversify the bets across a number of asset class. But in our view, staying invested, staying in cash is not the solution if we take today as a starting point. And the second point is diversification, right? Over the long run, Aussie stocks have done extremely well. Probably on a 20-year horizon, they've done fantastic in the last 10 years versus the rest of the world. Not as well, but still very decent. The point that I'm showing you today is that over time, right now, with more asset class available to Australian investors to easily invest in, you really get some very good diversification benefits. If you are comparing a growth portfolio, which is about 90% equities, even in a set and forget, what we call SAA setting, just holding 90% equities and 10% in bonds and cash, you will have better returns and you will have lower volatility across the journey. Okay, so there is an inherent benefit to being invested in multi-asset portfolios, and it's visible across a number of asset class, right? Now, how we go about investing and how can we make a difference for our clients? Well, we think that it's very important to have a multi-layered approach to investing, starting with asset allocation, okay? Asset allocation is the key foundation of our investment process. That's where we spend the most time on. But we have a 4-pillar investment process. So really asset allocation is what's going to set the direction and drive most of the outcomes. But we're trying to add value all along the way in various other pillars. Since I'll be spending a bit more time about asset allocation in particular, I'll just spend here a few minutes talking about what's next after asset allocation. So one of the things that we do that is quite specific, I guess, to us in Australia is that we don't have a set view in terms of being active versus passive in our multi-asset models, right? We have what we call the combined approach. We mix both funds and ETF in our models. Why? Because we think there is no asset class that's inherently better for active manager or passive investing. It's all about the timing. There's market conditions that make it more conducive for active managers. And therefore, given the very wide gap in terms of fees between active managers and ETF, and that gap is widening every day, we think it's important that we pay the right amount of fee in our portfolio, but we think also it's very important that we have the best performing strategies. There is no point allocating to an active manager if we think the conditions are quite adverse, right? So how we do that? We have a quantitative model that we set up here in Australia in conjunction with our US colleagues, and we are looking at a number of economic and market variables. A lot of them have to do with dispersion in terms of valuations, in terms of market performance, etc. So a market where we see a lot of dispersion means that very often fund managers have a lot more room to play. They can take a position that have more upside and they can really get the most out of their active management. Okay, volatility is one of the things we're looking at. In the last 10 or 15 years, the central bank action has suppressed volatility, and it was very hard. Everything was going up, and it was very hard for active managers to make a big difference because there was not a lot of room to play. Right now, with the market being quite dislocated, we see a lot more ways for managers to add alpha, and we are expecting our model to be around. But our models has been pointing towards, a majority of passive investment versus active investment in the last couple of years, right? There are asset class, of course, that structurally would point towards having more active investment. Small cap is one of them traditionally, but also it can vary through conditions. So that's something that we've backtested, that's been live with us for a while, and that's adding also a few regular bips of alpha in our investment process every year, and that's one way we can add value to our clients, and that's also one way we can reduce the amount of fees we pay to manager. But again, we have no issue hiring managers. There's plenty of very good managers. It's just that the conditions and the timings are very important to us. And then the next step, of course, is manager selection. We do use third-party research. A fund has to be rated by one of these leading third-party research with a positive rating for us to be considered for inclusion, but it's not automatic, right? We do our own due diligence as well on the ground. We have 2 full-time analysts here doing another layer of due diligence, and we do that on both the active and the passive side, right? So every single line in our model is backed by a research note issued by Morgan Stanley. And that's something we're very big on because we want to know and we want to have control over each position in the portfolio and make sure that there's no unintended exposure, because that's what really can throw you off in terms of performance. It's very important that you know all the positions very well and how they're going to respond to various market and macro environment. And lastly, there's the portfolio construction, which is broader than risk management, right? For us, portfolio construction is really about not only managing the risk in terms of actual portfolio versus our SAA, but it's mostly about making sure, again, that our positioning is intended, right? Do we have an amount of value versus growth in the actual portfolio that is aligned with our view on value versus growth, right? Can we scenario test the portfolio in the case, as we thought a few months ago, where we were expecting inflation to spike up? Is our portfolio in this scenario test going to perform better than our benchmark? It should be a yes. If it's a no, in this scenario analysis, we go back to the drawing board. Right? So before we make any change in the portfolio, we have this set of key macro and thematic view, and we must make sure that the end portfolio is aligned with that. Right? We look at VAR, we look at a number of other risk metrics, and these are very important. Another thing I like to point out too is very often when the market starts to move into, I shouldn't say panic, but very, very concerned fashion, you will see anything that's not core will sell off and sell off very aggressively. So very often in those times, it's good to be reducing the tracking error. One of the key variables we manage in those very volatile times is the tracking error, i.e. getting closer back to the benchmark, right? A lot of managers that are further removed from the benchmark will have a much, much tougher time. Right? So these are all the metrics we look at to make sure that our portfolio is well aligned with our market views. All right, so going back to step number 1, because I think that's really where we, as investors, can add the most value, is really about asset allocation. There's not a lot of things here you haven't heard before, but SAA is the main pillar. It's what's going to drive 90% of your portfolio's outcome over the long run. So if there's one thing we must get right as investors is that step, right? And how do you make sure that your SAA is well suited for your investment objective. In our eyes, it's a two-step investment process. It all starts with what we call the capital market assumptions, right? It's about forecasting risk and return for the major asset class over a set horizon. In our horizon, it's for 7 years, right? We do this forecast in conjunction with our US colleagues, really leveraging the Morgan Stanley strengths in that regard. And then we blend them together into the second step, that is the number 2, the optimization. Then we set them into long-term portfolio, strategic asset allocation portfolio, which we're going to use as the backbone of our model portfolios and multi-asset portfolios. And of course, on top of that, SAA is going to be the main driver of your portfolio outcome, but there's the TAA component that's quite critical as well. And TAA is really about anticipating and responding to the changes in the macro and market environment, right? And that also is very important, and that's how you can add another layer of alpha against that SAA that you put together. And why do you need that? Because unfortunately, in practice, things aren't really as good as what would be modeled in a simplistic fashion. So the first thing, going back to the SAA, after you've had your capital market assumption, is really to look at the way you're going to build this SAA, and are you accounting for the fact that the reality very often is more challenging than what a simplistic modeling of asset classes would have inferred, right? And that bell curve that you see, that return distribution here, is showing you 3 things, right? Is that if we look at a predicting model, so simple mean variance, what we call the Markowitz portfolio using historical risk and return, you have this nice bell curve, well balanced between a positive and negative return. But in reality, you tend to have 3 things that differ. Number 1 is that you tend to have more smaller gains, right? So a higher peak. Number 2, unfortunately, there's more black swans that you would expect. Right? There's always more black swans. There's more of them, and they are worse than what you would have modeled. Okay, and you need to keep that in mind. It will be worse than what you had originally forecast. Okay, and number 3, which is also a bit disappointing, is that there's more black swans, but there's also lower, very strong returns as the point number 3, as a mean variance testing would have implied. Okay, so very important when drafting an SAA to make sure that you're using quantitative modeling techniques that will allow you to account for the noisiness of return and the fact that there's fatter tails, right? So in our instance, we're using things such as Johnson curves. We also using CVAR to account for the fat tail. So we're looking also at a lot of back tests over time to make sure that our SAA will be reflecting this distorted curve. And now, how we go about active investing. And I wanted to run you through a working case. When COVID hit, right, we were quite still aggressive on our portfolio in the way we were investing. We know we were relatively late in the cycle, but we had the Fed by then easing monetary conditions. The economy was in relatively good shape, so we kept riding that positive momentum. But on point number 1, what really changed for us is, of course, we started hearing about coronavirus in China from late 2019. And in 2020, what we thought is that the data coming out of China in terms of electricity and coal consumption was not kicking back the way it used to after Chinese New Year, right? So here it was very clear, being able to leverage high-frequency data, that there would be a more permanent drag on economic activity than what most market economists were thinking at the time, right? So it's about using the data, and the data was clearly pointing to something that was a much bigger scale. Economists are always very slow to respond to that, even the best ones. Of course, because they always need more data, right? And here we're talking about high frequency data points, daily data points that they cannot really digest so far. So here, it's about using the full spectrum of what you can go back to the benchmark. Point number one, go back to the benchmark across the board. This is a high-risk situation. It is not the time to be carrying in one's portfolio things that can drop a lot in value if things do get worse. And things did get worse. And to be frank, we were good at forecasting that this would be much bigger than what most people thought, but we didn't think at the time that this would be a global crisis. We went back to benchmark and we sold even further because we thought that the issue in China would be enough to downgrade global GDP substantially. We didn't even thought at that time about the virus spreading to the rest of the world, right? When we saw the virus spreading to the rest of the world, we sold even more aggressively, right? But you got to think ahead, and you got to go to benchmark. When it's a high-risk situation, step number one, go back to benchmark. And then point number two, and that's one of the key advantages we have, Morgan Stanley being supported by such a fantastic research, is that our CIO, Mike Wilson, called the exact bottom of the crisis, right? Say, okay, it is too cheap. The Fed stepping in very aggressively. This is the bottom buyback. We bought back. And then point number three, our chief economist by then called a V-shaped recovery. So we were back in June of that year, and no one was thinking that this could be a thing, right? We thought living with COVID would be a permanent drag on growth for decades, and it would be a nightmare to get out of that, and the growth will not rebound aggressively. Our chief economist thought the exact opposite. He thought the amount of combined fiscal and monetary stimulus is unprecedented, is going to create a massive rally in capital markets, especially in risk assets, and you must be long. So we kept adding throughout this period, right? And so that turned out to be a very, very positive year for us. We traded over 30 times. On average, we're trading 6 to 8 times a year. But when markets are volatile, you need to stay on top of markets. You need to be as active as the market pushes you to be. The following year, we only traded 3 times, right? But on that year, we needed to trade quite a lot to keep up with market activity, and that helps our growth portfolio to outperform both the ASX and the peer growth portfolio. And that was in conjunction of good decision and a great support from the Morgan Stanley research. And that's one of the key things as well, is that good decisions are made based on good research, right? And intuition is clearly not enough, as we all know. And one of the things we can leverage at Morgan Stanley is really the fact that we have great research, both coming from the Insto side with more than 700 analysts, strategists, and economists working worldwide 24/7, with whom we're catching up on a regular basis, but also a US entity that's developed a number of best practices in terms of managing multi-asset portfolios for the wealth management universe. So it's really 2 key levers we can pull. All right, I also wanted to give you a bit of a view as to how we position right now. I know Morgan Stanley has been quite vocal about being cautious this year. It's quite well known across the industry, and unfortunately, I'm not a bearer of very good news today. We think that we are not done with this correction. This has further to go. I put that chart on the left-hand side versus an average bear market. We're quite advanced, but versus what we expect of this one, unfortunately, and as you can see on the right-hand side, we need to see more derating, right? So the chart on the right-hand side shows you that we got into this bear market with very, very high valuations. And with the spike in inflation, pushing the central banks to respond ever stronger, this is going to continue to compress valuation, right? So we need to see, we've seen substantial valuation derating, but if you look at where these ends in general, there's further to process. That's number one. And the second thing is that we haven't seen enough earnings downgrades as yet. We've seen decent PE or valuation derating, but the analysts have been very shy about getting EPS growth expectation for the next 12 months and the following 12 months. When this will happen, mechanically, equities will be expensive again, so they will derate again, right? So we expect that U.S. equities, to give you a bit of an idea, show a lot more value around 3,400, but that's assuming we get a soft landing in the U.S., which itself assumes, and that's where the Fed is moving to, and I take that as a good news, that the Fed pushes on the brake extremely hard this year to stop inflation momentum so they can ease maybe towards the end of next year or the following year, right? If they get too gradual about their pace of hike, it might not end very well, right? So a lot of markets have processed a lot more derating than the U.S. equities. We have an issue with U.S. equities right now. That's our view. And I actually can move to the next slide. A lot of markets, Europe, China, are trading relatively cheap, but there's a lot of uncertainty, so we don't see we can go back in there right now, but a lot of the derating has happened already. Whereas in the US, still trading above 16 times, that's not cheap enough, right? So unfortunately, US equities being 55 to 60% of the global equity market, they will continue to drag the whole market along with them, right? Until we get to the point where the market is convinced that we've hit peak Fed pricing, that everything's priced in terms of how much the Fed will have to do, and that this will get to a soft landing. Unfortunately, we're seeing more volatility ahead. Australian equities have derated also. They're about 14 times, a bit cheaper than the long-term history. They're getting a boost from the fact that we are a net commodity exporter here in Australia, and a lot of markets are imbalanced in terms of supply-demand dynamic. We also are a bit more defensive by nature and a higher yield market, right? So one of the things is that dividends have kicked back into the Australian index, and now dividends at 4.6% are roughly on par with what our estimate of inflation was. So it's actually holding on to Australian equities for us make a lot of sense. We don't expect them to derate a lot further. It's really global equities, the high growth segment, and the US equity segment that we think is the most at risk. So having a blend of very defensive allocation and inflation hedges such as energy stocks and commodities is the way to go. In terms of international equities, we'll like, again, utilities or everything in what we call the low volatility bucket. And in fixed income, we think that the market right now is trying to catch up with this persistent inflation. Bond yields, will continue to go high. The short end of the curve, especially outside of Australia, is a bit tricky, but the back end, if you want to buy protection versus the potential of a recession, is not a bad place to be right now. Also, the carry has increased between 3 and 4% in US and Australian bonds. If we go into a recession, those bond yields will come down. So probably in bonds as well as in equities, things will get worse before they get better. But we don't think it's a bad time to be bringing protection back into one's portfolio, buying a bit of duration. But we recommend being underweight duration as a whole because there's still a risk that, again, bond yields move further up before they go down. And alternatives for the portfolios, and those of you that can invest in alternatives, talking about our framework for investing active versus passive. alternatives and especially hedge fund managers, they had it tough for 15 years because you just had to go long and the central banks had your back as an investor. Now things are changing and they have plenty of room to add alpha. We like relative value strategies, strategies that can be both long on one end and short on the other, and especially market neutral. So having no directional bet on the market, but the ability to leverage a position where things are going to get worse or things that are going to get better. All right, so that's how we position right now. You can see we're quite conservative. We have a mild underway to growth assets. We have an underweight to Australian and international equities. Might appear like we have a bigger underweight in Australian equities, although we like them better as a group. It is true, it's because in international equity we fill the bucket with a lot of low vol strategies that we can't find in Australia. But net, we have a massive bias towards cautious and being defensive. In fixed income, we are also very cautious. We have a blend of floating rate and government bonds, and we're holding cash. I think I've never said that before a couple of weeks ago, but I've always hated cash, and I've always advised clients to be as close to zero in cash as they could. And it's not yet a great time to be back in cash, but it's a time, like right now we're holding that tactically. US cash, if you can hedge, I mean, if the US cash goes up to 4% by the end of the year, it's not too bad. TD rate, swap rates in Australia are showing some value. You're going to struggle to beat inflation, but if you need to buy a house or something like that in the next 12 months, maybe that's not a bad place to put the money. All right, and I'll just finish by showing you the performance, because all of that is meaningless if we are not delivering for our clients. It's not about the people. It's really about the process and the consistency of the process, and that's what helps you generate performance over time. There will be times when we quite risk takers. So we like to take advantage of market volatility. We like also to be cognizant of protecting the value for our investors. And our approach to that is really to try and pick the right time to be invested at the maximum. Right now is not that time, but to deliver this great outperformance, at some point you need to buy back, right? And we are very, at this stage, very much watching the market in the next 6 to 12 months to see how we're tracking versus all these events. But we are not forecasting a recession at this point, and we are still thinking that we are in a multi-year bull market in terms of secular bull market. So the 10-year outlook for capital market and multi-asset portfolio, in our view, is a constructive one. Right now, we're a bit more defensive. When we see opportunities arising, we will get back in. All right, and thanks to IMAP, been a great supporter. Thanks, Toby. Thanks, Jenny. And thanks, David, to award us with those awards in the last couple of years. I'm happy to take questions.
Yep. Any questions for Alex?
Here. No? So is Morgan Stanley taking the volatility and what's happening today as more of a correction than anything more major in the market?
Well, so it's another due readjustment on equities that have been binging on free liquidity. This has been wiped out. Okay, we think that right now we're at the point where most of the excesses from a valuation standpoint have been wiped out. Now the issue is the next leg, right? How much of a slowdown are we going to get? If the central bank action destroys so much demand that we have to cut GDP growth again very drastically next year, we will see another leg down in equities, and a substantial one. Okay, and it will look more like a recessionary bear market, which usually are around 30%. We're only about 20 right now, peak to trough, right? So I'll be very honest with you. Us, like many other people right now, we're watching the risk of a recession. We are not calling a recession. We don't know whether we're going to get a recession, because to know that, we need to know where is the Fed going to be in terms of cash rates, and the near-term implication for demand destruction. The retail data print that we had in the US, I think 2 days ago, was showing finally retail sales, and in real terms, especially rolling over. And these will be the sort of things we'll be watching in the next 2 or 3 months to position against a recession, and whether we get another small leg down of 10% like, or a much bigger one.
Are there any turning points you're looking for?
Yes. So one thing I didn't talk about today, of course, but that's a very important issue to us is the situation in China and Ukraine. I believe that if we were to see stabilization, right, any sort of freezing of the situation that involves the fact that the war stops. The release of the wheat and the resumption of agricultural production in Ukraine would be very positive because they would create an automatic fall in commodity prices. We have to keep in mind that commodity prices they are, to the rest of the world, a bit different to Australia, but to the rest of the world, they are equivalent to monetary tightening, right? Because when you fill your car with petrol at $1 or $2, it's a very different impact on your budget. So it's a tightening of financial conditions for you, right? And in countries such as where I'm from, in Europe, we hardly produce any energy. The cost of energy is extremely high. Wages are quite low, and people are really struggling right now. And that, so if we were to see a fall in commodities driven by an improvement in the situation, which would also improve sentiment, that would be a key thing for us. We need to see the cases in China staying as close to zero as possible, so China can really restart the engine. They're preparing plenty of measures, and we think the resumption of the activity in China is going to be very good for China, but also very good for the rest of the world, because we're talking about supply chain issues, but all supply chains are linked right now to what's happening in China. Right, so we can't. That's also creating these supply chain disruption weighing on inflation. If inflation comes down, the central banks are more relieved. They can stop where they are, and things will go back to normal. Okay. The other thing on the flip side that I would be watching is commodity prices, because commodity prices are where they are based on demand forecast. If we're headed into a recession, suddenly commodity prices will fall off a cliff in a couple of weeks. And that will tell us that traders that are very well informed are now thinking that it's the demand side of the economy that's about to collapse, and probably that would be a leading indicator for a recession. Okay, so these are things we're managing on both fronts. But the situation is very, very fluid.
Yep. Last question.
Thank you. Just a quick one. Do you try and factor in geopolitical issues? Because when things go back to normal, if they go back to normal in a reasonable term, China goes back to normal in terms of its global ambitions in the Pacific and elsewhere, and the potential problems in America coming up to elections, etc. How do you factor in the geopolitical things from, let's say, America and China?
Yeah, so we have, these things are factored in by our economists in terms of multi-year macro outlook. For us as portfolio managers, it's about the potential disruption from any given change in our short-term positioning, right? And what I would say is very troublesome with geopolitics is that they very often have a very high human cost, and as individuals we get moved by them quite a lot. But the impact on capital market is very different, because capital markets tend to discount that very quickly. So right now, the war in Ukraine is priced into capital markets and it's priced into commodity markets. So we've responded to that. We've positioned by being very long commodities and long to a series of commodities that would benefit, if we can say so, from the situation there, or I should rather say using that as a hedge. And if we were to see that unwinding, as I said, it would have a myriad of consequences that we would act on. Unfortunately, with geopolitics, I find that very often you can have a view on what the end game is, but very often you need to respond. You can't anticipate very much because most of us, probably all of us, are not informed. We are not in those inner circles. We are not told about what's going to happen beforehand, so we need to respond. So we keep an eye on that and we manage the risk. Right now, we have this long commodity exposure in case the situation gets worse, for instance.
Okay, thank you, Alex. Well done.
Thank you.
Big hand for Alex, please. Thank you. Cheers.
Thank you.
Thank you very much.